What is going on, everybody? I have a special person with me today, an old friend of mine, not an old man, although he does have a few more gray hairs than I, but an old friend. I've known him for a long time and have always respected Mr. Eddie Speed in what he does. So, a little background on Eddie: he owns a business called NoteSchool, and he has bought and sold more notes then you can count on a couple fingers and a couple toes. And I'm sure he'll explain that a little bit more as he introduces himself. But one of the things that we are here to talk about is a exit strategy that you may or may not be thinking about as a real estate investor. And so you're getting this video from me because I think you are somebody that needs to be considering this method in your exit planning for your piece of real estate. Now, is this going to work for every single piece of real estate that you own? No. Is this mean you're never going to buy real estate again? No. What we're saying is that we understand the current market has allowed for a ton of appreciation. It has, but it's also, along with that appreciation, it has increased expenses. We've got insurance costs going up. We've got tax costs going up. We've got rent not going up as fast as we want. We've got turn costs. We've got construction costs. So we've got all these costs coming in. And so the net on these rentals aren't what they used to be, right? And so they're getting tougher and tougher to maintain, tougher and tougher to keep. And so Eddie and I were speaking at a conference. I don't know. Who knows when we were we talk about selling these properties on seller finance all the time, but we really started diving into it 6 months or so ago and talking about, listen, this is the time where there is so much opportunity in the market where people need properties in a different way and people want to sell properties in a different way. And so what I wanted to do is bring Eddie to the table and talk a little bit about what he's doing, what he's seeing in the market, and how to take advantage of a different exit strategy than most people will kind of think about. And here's the thing. What I know in any real estate market is it's the ones that are creative and that adapt to what the market's giving them. They're the ones that are the most successful. So that's what we want to prepare you for today. And I think this might be a great opportunity for you. So Eddie, what did I miss? Tell me. I want to know how many notes. I know if I would gave him the number, I would have been low. So I just said a couple. Well, how many notes have you transacted in
I,
your career?
I've bought over 50,000 seller finance notes.
Yeah, yeah. So you know a little bit about it.
Well, it's basically it's my space, and it's a subject that I've studied a lot. And I saw this market scenario creeping on us a couple of years ago, but I think you agree, like the market wasn't ready for facing down the road yet. And so this is a concept where I would say that your clients that have rental houses, this doesn't apply to duplexes or multifamily. This is for houses because you're selling it to a consumer buyer, somebody that's going to live there, not an investor, right? And Marcus, I'm going to start out by saying this. What's more profitable today in landlording? The landlord or the bank?
It's definitely the bank. It's definitely the bank.
If a house is making a 4 cap and the bank's charging 7.5 for a DSCR loan, it sounds like the bank's winning. And so that's just a concept we'll lead with, and I'm going to try to go through this quickly, Marcus, and I want you to kind of stay with me and help me transition to the next thought. But the first idea I want to start with, Marcus, is let's look at the market back in time a little bit, and let's look at it today.
Sure.
Okay. So let's go back in time. This was a house. This is actually an apprentice that works for me, and he lives in your hometown, Mr. Marcus, in Springfield, Missouri. So this was a real property in Springfield, and just happened to work out that we made a good. I think it represents the average. You know,
Love that.
It's not extreme on either side. It's the average. So in 2018, this house is worth $120,000. It rents for $13.50 a month. Back then, Marcus, best we can see that expenses were about 35% of gross rents, which meant you netted about 65%. So you were going to net on that house, you're going to net $877 a month. Okay. That was a 2018 model, and you were deep in the space back then. And I'd say you could say whether that's true or false, but I'm guessing we're okay with it.
we got to be in the ballpark, right?
Yep. That house made almost a 9 cap back then, Marcus.
Sure.
Let's go forward in 2025. Well, wahoo, it went up in value. Okay. So you got an increase in value, but it's a little bit like stocks. You got an increase in stock price, you just didn't get a check for it. Right? The rents went up, so there was a lift in rents, but expenses went up. Right? So it went up to $1,700 in rents, and expenses were 50%. So if you really look at it, that house is now renting about $850, and shockingly, its net income is less than it was in 2018.
Yeah, and that's the scenario, right? That's what we're seeing across the board is the net, especially when you look at it compared to what your fair market value is. We talk about return on equity all the time. This is right what we're talking about.
So if you look at this house today, it's at a 4.5 cap, and we've modeled 50, 80 different cities, and it's between a 275 and a 4.5 cap is about where it drops. So this is actually on the high end, right? We didn't pick the most crazy scenario we could have picked, right? And the good news is we had a lift in value, but my issue here, Marcus, is are you getting paid for this lift in value? And that, I think, is where the rubber meets the road. You can get paid for it, but not by renting it.
Yeah.
So what happened, Marcus?
You tell me.
I think it's this. I think that there's a mismatch between the income lift and the expense lift after COVID. Now, you're the numbers man.
Yeah, I mean, just like we started off talking about, right? We're seeing taxes go up, we're seeing insurance go up, we're seeing, you try to get a handyman out there for less than $100 an hour right now, right? It's no matter what, all those costs are going up. That's your inflation, that's your expenses.
The thesis that people had when all this started, Marcus, is that everything was going to lift like this. You were going to have a lift in expenses, but you're going to have a lift in rents. But that's not what happened. And so this is what threw the category out of thing. And from an old friend of yours and I's, Mr. Richter, he had a saying that I never will forget. And he says, "Who drank your milkshake?" And I say, "Inflation drank your milkshake."
Yeah.
Right? So this is reinventing yourself, Marcus. This is the reinventing yourself. This is where you kind of turn off one side of your brain and turn on the other side of your brain. Because how many times in business, Marcus, do you see that there is a way to a path, but we have to abandon what we thought was going to be the plan and adjust? You've got a good house, right? Yeah. It's not that you have a bad house. It's that what do you do with the house? And my thesis is you sell or finance it. Now, if you can make a 4 cap on a rental, I'm 100% certain that without any leveraging, you can make a 10 to an 11 cap on a seller finance house. Same house. But wait a minute. I'm also going to show you at the end of this presentation how to use some leverage and sell part of your note and pay off your underlying, and then your equity is going to have kind of a crazy yield to it. Yeah. So everybody thinks in terms of having leverage with a rent house. I'm just showing you how to have leverage with a note. I bought 50,000 of these things, right, Marcus?
That's right. That's right.
Okay. Well, I didn't fund them out of my wallet.
I was going to say, did that all come out of your pocket?
Yeah. So let's go to the thesis of you're going to seller finance this house, right? So I didn't pick any wild numbers. You're going to get 10% down. Okay. You're going to seller finance 90% of the sale of the property, right? Remember, you're the bank. And we picked the terms of this loan, and I used a non-QM mortgage rate, non-qualified mortgage rate. Marcus, 40% of the loan origination market today is non-QM loans. So this is a very definable market. Okay. So on a 30-year AM, your payment is $1,816 a month on a 30-year payout. And, I think there's a couple of things, Marcus, that I think people tend to forget. Everybody in the world that's a client of yours can tell you every tax hack known to owning rentals. But what I find is that very few people are aware of any tax hacks related to carrying a note.
Sure.
And the answer is the IRS will let you pay a lot of the money that you owe back to them with tomorrow's dollars.
That's right.
Right? So this is a big deal because I'm not paying the IRS today. I'm paying them as I get paid. And that's both with long-term depreciation recapture and with installment sale.
Right.
For capital gains. So the other thing is I am going to show you some multiple strategies here where you can create very good mortgage paper written to a very specific formula. I think we can help you with that. And then all of a sudden, I'm going to be able to take your loan to the secondary market and sell that loan or a piece of that loan to an institutional investor. And then you're going to keep part of the payments. Now, there's more than one way to do this, Marcus, but I'm just going to go down this lane just a little bit, okay? So the first thing we had to do is find a good house that needed to reposition and find more income, right? Yep. Took it from a rental. Now it's a note. Now all of a sudden we're creating a good note. And I think I can help people with that. I'm going to encourage your clients to do this. This is what I've spent my life's career doing, is learning how to create good notes that will fit the secondary market. So just because you seller finance doesn't mean that you exactly have the recipe right? That's how I've done 50,000 notes, is had customers create notes to a formula that we helped them with. We just look at ourselves as partners with you guys. And the biggest thing, Marcus, is I think now all of a sudden your equity isn't trapped because now you're getting paid for your equity.
Right. Right. That's how we were able to turn it from a 4 cap to a 10 cap, 11 cap, 12 cap.
Yes, sir.
Because you're getting equity now.
Okay. So here's the biggest question people have.
It's complicated.
Who is the buyer for this house?
That's
right. Seller financing has kind of a reputation. It's a buyer of last resort. And I want to show you why that is not true. Let's go look at the mortgage banking world. This was the Mortgage Credit Availability Index. Okay, so this is put out by mortgage bankers. And this is an index that they have that says the standard it takes to qualify for basically a Fannie Freddie loan. Look at it the day before the virus. Mark is right in here. And they were at 185. Got that? That's the day before the virus started. Look at it today, and they're at 95. So what you see is a lot of people left behind. I say that seller financing today is finding a just missed buyer that practically before the virus, they would all gotten a conventional mortgage. But today, because of underwriting, they don't. That's the market that we believe that we serve.
Can I take it one step further, Eddie? That I think, and I would love to get your opinion on this because So here's my philosophy. We're in the post one big beautiful bill era now. We got 100% bonus depreciation. I think the market is going to go after every potential rental property that they can and put them into, basically take them out of single family service. What that's going to do is limit the ability to buy houses. So when you are selling a house and you're selling it on seller financing and say, well, that is the way you qualify to buy this house, and there's only so many houses for sale because in that price range because the hedge funds have come in and bought them all up. And so my prediction is it's going to be hard to be a homeowner, even harder to be a homeowner. The average age of homeownership is 38 years old today in this country. And so where I think the benefit is, and this is where Eddie and I agree, is that there is going to be more and more opportunity to seller finance these properties because of the necessity of that in the housing market. It's got to make the housing market work because to this point, this is just credit availability. But what happens when there's not housing availability? And the people that are selling the houses are the ones offering the loans. That's going to be the case.
So, Marcus, I agree with that thesis, and I agree with you that at the end of the day, we are serving a market that not only do we make a lot more money, but by the way, it's great for them.
Yeah.
Well, why not have a business that's super profitable that you can go help somebody that otherwise is getting left behind for no good reason, by the way, right?
Sure.
So I'm for that. And so what I wanted to do next, Marcus, is let's look at a comparison. Let's just dollars and cents it. You're really good at this, right? And so let's go take this house and take the rent side versus seller financing. Okay. So the income is 700. This is 1700, excuse me. And that is today's gross rent. Then we take out expenses, 50%, which leaves us now left with $850 in income. So this now becomes your real income in the deal, right? That's your real income on the rent side. Seller finance the same property, and all of a sudden you got no expenses because even the buyer can pay for your servicing cost. So you got no expense on a monthly basis. So you're $1,000 more a month. You're $1,000 a month more in income, Marcus, or call it $960.
Yep.
Same house, you just change the use of it. And by the way, remember you got 10% down. And so when you take that money off the table, Marcus, now your cap rate's about 10.5 versus 4.5. This is just, what I love to say is this is just math. By the way, one of the deliverables we're going to give your team at the end is we're going to give them a spreadsheet where they can just go test it. They can go take real properties and just go see if it's true. One thing about Excel, Marcus, it takes all the emotion out of it, right?
Yeah, that's right. It's math, right? So one thing that I'll go back to, this is where I know people will ask the question. They're like, well, Marcus, okay, on the left side, you got 50% expenses. You got no expenses on the right side. But this is assuming I don't have a loan on the property, right? Well, if you got a loan on the property, you're going to have, you got a loan payment in here one way or another. Either on the rent side, you might have a loan payment that's $700 a month. Well, that cash flow is actually $150, not $850. But on the seller finance side, you'll also have some sort of debt that you will have to pay. And Eddie can walk you through that. That's really, it's more complicated than probably he's going to want to get into today. But ultimately, it still maths out the same where, okay, if you had debt, it maybe reduces your net, but you're still $1,000 ahead.
Let me be clear about this. I'm not teaching you to wrap a loan that doesn't allow for a wrap. That is not what that is not the plan. I'm teaching you how to create good paper where you can go liquidate part of the payment to have the cash to pay off the loan, and now you own a percentage of the payment that's a first mortgage.
That's right.
So I just haven't quite got there yet, but believe me, the liquidation of this note is part of the strategy. Creating the right note on the right property is the key to creating paper that will trade in the secondary market. That's kind of my specialty, right? All right, so let's look at this, Marcus. There's kind of three reasons that I believe that people say I would seller finance. And first and foremost is it is way easier to be the bank than a landlord. I mean, Marcus, you spend your whole life helping people run numbers on their businesses. And how many times is the stress of running the business the number one thing your client needs to get rid of?
100%. Yeah.
So this is, I say that you could have 55 rentals or 1,000 notes for equal the same amount of work. You just pick which side you want. Okay, so less stress. And there's also a cushion factor with notes that you don't have with rentals. Okay, because remember, when you sold this property for market value, whose money is that? Oh, that's the buyer's money. He took your money off the table and put his on the table. It produces a cushion. And that could be true whether you get 15% down or whatever the number is. I use 10% as a super conservative number. That is the minimum standard. I believe that you can average 15% down. The average down payment for a conventional mortgage today is 19% down. So now you have a cushion and in this deal that you don't have in a rental, because you surely don't get 10% from a tenant, right? So, Marcus, leading to your next thing, which was liquidity. Like, how do I have a cash event that would allow me to pay off my mortgage? So here's how it works. You're going to sell a percentage of your loan payment. There is more than one way to cook this pie, but this is a way to do it. So remember, this was money you took off the table, right? That was a down payment. Now you financed 207 and it produced a monthly payment for 30 years of $18.16 a month, which essentially, if you looked at a timeline, that's what you have. You have 30 years worth of payments at $18.16 a month. It is possible that you turn around and sell that portion of the cash flow. So you sell part of the payment. You could sell 50% of the payment or 80% of the payment. Okay. And then you can keep part of the payment every month. And by the way, I built a spreadsheet where you can test this. Marcus has already looked at it. It's pretty slick and just, you don't have to enter many numbers. The spreadsheet lets you enter your variables and then it does the calculations for you, right? So this, all of a sudden, I believe, Marcus, changes the dimension of how somebody can look at their business. And remember, all of a sudden now, this is today money. And this is cash flow. Because what you wanted a rental for is really a long-term wealth play, right? I mean, that's why people did this.
Right.
And so it's really a challenge of saying it under the current situation when my properties are not making, if you own an asset and you're making 4% return, Marcus, that's usually not what people think is a great deal today.
Yeah. Well, and here's the thing. Here's the reality of what you're giving up, right? There's always cost versus benefit to everything. And what you are giving up is future appreciation for today's annuity. That's the deal. And like when I started this conversation, it's not going to be for everybody and it's not going to be for every property, but in the properties that it makes sense, and you can have, a lot of these people that I'm sending this video to have 100, 200, 300 properties. And when you can turn that into maybe 10, 15, 20 notes that are sending you a good chunk of change every single month, that does truly become passive. That is truly what you were set out to do, and you didn't have to do it through owning that rental real estate. And the reality is, I'm sending this to you because you're looking to sell out of your portfolio, and this is just another way for you to sell out. But this way of doing it allows you to keep a check every single month versus paying, selling out and then paying the government or having to go through a 1031 exchange or whatever we've got to do in that scenario, which might be the case for some assets, but this is another way to do it.
One thing that I'm going to say, Marcus, is I think I can prove mathematically is that you are getting your appreciation. You're just not waiting for it.
You're getting it through your interest. Yeah.
I mean, because if you wait for your appreciation, if you take $1,000 and it's due 5 years from now and you run the present value on that, it's about 60 cents on the dollar, right? Sure. So if you're getting money today versus having to wait on it, there's a great mathematical argument. It's a little bit down a bunny trail. I don't want to get too deep into that, but it's a decent argument that I think is true. All right, so let me give you guys kind of the bottom line. It's who are you selling to? What terms are you selling under? It's like the terms of the sale, the terms of the note, vetting the neighborhood, vetting the property to make sure that it's going to fit the institutional investor. It's like all the mechanics behind the scenes of, do you need a transaction coordinator that's a specialist in this field? You're going to need a third-party licensed RMLO residential mortgage loan originator to be compliant. And all of this can be easily done. You're going to want it papered the right way. Don't paper it on a land contract and all that stuff. That's not tradable in the institutional market. So let me help you with that, because that's what I spent my life's career learning how to do. So this is the journey that we would like to help you with, right? And we've got resources in every one of these categories that we can help you. I mentioned to you a spreadsheet. You're going to enter in a very limited amount of information, and the rest of it's going to be pretty simple. Okay. Awesome. And awesome. This is how they're going to do it. So the first thing they're going to do, Marcus, the next thing is I'm going to show them how to make contact with me, but I want them to do a little bit of homework, if they will, that it's going to allow us to be a lot more efficient in a conversation. So this really is for your tribe, Marcus. They're going to go to noteschool.com/Marcus, or you can do the QR code thing, right? I'm going to give you kind of a 10 steps little instruction manual. I'm going to give you a white paper that kind of takes what we did today and breaks it down in a little bit different language. And I'm going to give you that spreadsheet. So I'm going to give you 3 take homes. And so it's noteschool.com/Marcus. If you got that, guys, and I'm going to move to the next slide, and I'm going to say, once you do that, then I'm going to give you my personal email, and I want to set up a call with you. I am going to ask you, please, to at least get yourself a little bit up to speed, because it's going to let us move much faster into more questions that you're going to want to ask me. It'll make when we get together more effective, I believe. Okay. And then basically here's my email, and just email me, and my assistant will give you a scheduling link, and we'll get a call scheduled and do about a 20-minute call. And listen, if it's not a fit for you, Marcus or I, either one, don't want you to do it. But if you think this is a possibility, I want to kind of help you. I want to give you a compression of time. I've been doing this for 45 years, closed a whole bunch of deals. I want to give you a learning curve compression of time, like the best things that I've learned over the years of how to do this.
Yeah, I love that. Thank you, Eddie. By the way, just as a quick aside, I don't get a dang thing for this, right? This is just simply what I believe needs to be thought about in the market. I've thought about it. I thought that this is an exit strategy that needs to be in the market anyways. And even more now, where we've got people that want to recycle their assets. They want to buy new assets coming in, but they don't want to sell all their old assets without any sort of a long-term benefit there. This is who that's for. And so, Eddie, I appreciate you jumping on here and talking about this and opening the eyes to several of our clients. I expect to see some movement here, because I think it's a big deal. I really appreciate it.
Well, I appreciate it. I think we all have a vision for the business and the opportunity, and I certainly appreciate your introduction to your clients. And guys, we just want to serve you guys in the best way we can. So I look forward to hearing from you.
Awesome. Thanks, Eddie. Appreciate you.
Bye-bye.